Hello and welcome to another Zoom video here that I've been telling you all about that we'd be sending to you. Um, just wanted to give some proactive year-end tax planning ideas. It's a workshop we put together. One of our main goals as a comprehensive financial professionals is to help our clients recognize tax reduction opportunities, both within their investment portfolios and in their overall financial planning strategies. Staying current on the ever-changing tax environment is the key component to help our clients benefit from potential tax reduction strategies. The objective of this workshop is to share strategies that can be effective if considered and implemented before year end. Please note that this workshop is not a substitute for using a tax professional. In addition, many states do not follow the same rules and computations as the federal income tax rules. Make sure you check with your tax preparer to see what tax rates and rules apply for your state. And that's especially important here as we have people in Oregon and Washington, two completely different states. So what I want to talk about today is year-end tax planning strategies. It's pretty straightforward. While doing so, we'll discuss some tax planning ideas and strategies that you can consider. We believe in educating you, our clients, on their choices is very proven. Our goal today is to give an overview of tax planning so when you look at your situation, you have some strong foundational information. Just please remember that each taxpayer situation should be looked at individually. The good news is we are able to talk to you about your specific situation, and we have in many cases. But we'll continue to do that, especially as we come through this next election, which is coming quickly. First, before the presentation, I'd just like to take a minute and remind you it's really important to us that you stay healthy because your health is our highest priority. Without you being healthy, we're not here. We are still experiencing challenging and unprecedented times. And as we like to share, your first wealth is health. I find it, so as always, we just find it important to review that there are 5 areas of financial planning that we always look at. They are preservation of planning, retirement planning, tax planning, estate planning, and investment planning. Today, I want to talk about tax planning, which can also affect estate planning. As a comprehensive wealth management firm, we try to always consider the impact of any of these recommendations we make on not just one, but all these areas for our clients. Tax planning for 2020 became a little more complicated. Because of the Secure Act, which was signed into law December of 2019, and then the 2020 CARES Act added some new laws and rules for taxpayers. This all happened in a pretty short period of time. Also, being a presidential election year, it's really helpful to consider some of the tax proposals that are being discussed so that you can plan in an informed way, especially as we come through the end of the year, as we know something will happen after November 3rd, and we just want to be watching this carefully. So let's start by quickly distinguishing the differences between tax planning and tax preparation. It's really important. Tax planning is looking ahead before year end, whereas tax preparation is filling out your tax forms after year end. What we're talking about today is tax planning, not tax preparation. It's about hearing some proactive ideas that you consider now to potentially reduce your taxes. One of our founding fathers, Benjamin Franklin, is credited with saying, by failing to prepare, you're preparing to fail. I've got 2 screens here, so bear with me as we work through this. So still learning how to do this Zoom thing here. Let's start really by distinguishing the difference between So for 2020, there's 7 rates in 2020, 7 tax rates. And usually, as you can see, it's 10, 12, 22, 24, 32, 35, and 37. Under current law, the 7-rate structure was created by the Tax Cuts and Jobs Act, and it's scheduled to automatically phase out in early 2026, January 1st, 2026. Here are the current tax rates for married filing jointly and single filers. Married filing jointly has lower rates on many amounts. For planning purposes, something you need to remember is that even if no changes are made to tax rates, in 2026, the law says we go back to the older higher rates prior to the Secure Act. Tax brackets are important, and current tax laws call for a sunset in 2026, which means we go back to the older higher rates automatically in 2026. So when we're thinking about your plan, we need to remember this. As this arrow shows, for some people, that means income that would be taxed at 24% today could be taxed at 33% in 2026, which is a much higher rate. For 2020, the standard deduction amounts are $12,400 for individuals, $24,800 for married couples filing jointly and surviving spouses, $12,400 for married couples that are filing separately, and $18,650 for head of households. So remember, the Secure Act in states like Oregon and the big high tax states really affected us and what we can eliminate in those itemized deductions. So how would you view itemized deductions if you did not take the standard deduction? The old rule was to accelerate or realize deductions and take them as soon as possible. With the higher standard deduction, the new rule is time or plan deductions. Mortgage interest, deduction limits. Two of the more widespread deductions that taxpayers look at if they choose to itemize and not use the standard deduction are mortgage interest and state and local taxes, more known as SALT, S-A-L-T. Under the new rules, for mortgages taken out after October 13th, 1987 and before December 16th, 2017, mortgage interest is fully deductible up to the first $1 million in mortgage debt. That threshold has been lowered to the first $750,000 or $375,000 married filing separately on homes that are purchased after December 15th, 2017. So for those of you with mortgages, please check with your tax preparer for how much of a deduction you could take. The TCJA, the Tax Cuts and Jobs Act, is also limited state and local income and sales and real personal property taxes like we were just discussing, especially in these high tax states like Oregon. So we have a maximum deduction now of $10,000. So it's really hard for a lot of people to continue to itemize. One strategy for taxpayers who like to give to charities is to consider bunching charitable contributions. Here's an illustration of how that could work. So if you're married filing jointly and had $10,000 of state and local taxes, which includes property taxes and $5,000 in mortgage interest, and give $10,000 to charity and no other itemized deductions, then you would have itemized deductions of $25,000. The standard deduction for you is $24,400, so you would gain $600 by itemizing. In a 35% federal tax bracket, that has an after-tax savings value of $210 to you. If you were able to do that for 3 years, you could be worth $630 to you. An alternative strategy is to gift $30,000 in 1 year and then use the standard deduction in years 2 and 3. That would bring your deductions to $45,000 in year 1 and save you $7,210 over the standard deduction in year 1 at a 35% rate. By doing this, you would lose the additional $210 in tax savings from years 2 and 3 that you received in the other scenario, but your tax savings is $7,210 versus $610, which is $6,580 more. So now you might be thinking $30,000 is a lot to give in 1 year, so let's look at how a donor advised funds or DAF works. If you place the $30,000 in the donor advised fund, you get the deduction immediately, and then you can give the charitable contribution as you see fit. Some of this gets pretty complicated. If you have any questions on this, you want to talk, just please give us a call. Something that the CARES Act offered that is new for 2020 is a new charitable, is a new charitable deduction available to taxpayers who did not itemize their deductions in 2020. This new benefit is known as a universal deduction. It allows for an above the line or before you calculate your taxable income charitable deduction of up to $300 per individual, $600 for married filing jointly. To qualify, the charitable gift must be cash or cash equivalent made to a qualified charity, 501c3. This contribution must be made on or before the end of the year, 12/31/2020. As this draft 1040 from the IRS website shows, this deduction can be taken before you calculate your adjusted gross income. If you are itemizing or did last year and like to give to charity, please think about using this deduction and remind your tax preparer that you did. Qualified charitable distributions, QCDs, are a strategy for retirement savers. Many of you have been using these. As part of the Secure Act, required minimum distributions, or RMDs, which were waived this year, were changed to start at age 72. That was through the Secure Act, instead of age 70 and a half. Also, the CARES Act allowed you to skip or not take your RMD for 2020, like I just mentioned. Qualified charitable distributions are a tax law provision that allows retirement savers over age 70 and a half to directly contribute up to $100,000 to eligible charities straight from their retirement accounts and not pay tax on this distribution. It has to go straight to your charity. One idea that experts suggest is if you're charitable inclined, consider using part or all of your required minimum distribution or RMD for qualified charitable distribution. Depending on what happens here as we go into next year with the tax code, we'll be talking to many of you more about it as the RMDs come back. Like many of the other strategies we are discussing today, this is one you should, of course, always talk with us if you're interested and will want to evaluate your situation at all times on this. In 2020, long-term capital gains still received a tax break. This is really important. Here are the three tax rates of 0%, 15%, and 20% for long-term capital gains. This could change next year, and we'll talk about that here in a minute. One planning idea is that many taxpayers, and we do a lot of for people all year long, especially as we come into the year end, is what we call tax gains and loss harvesting, tax harvesting. Harvesting capital losses is a strategy that has a taxpayer selling assets that are a loss to offset capital gains. It reduces or eliminates tax on current capital gains. On the surface, loss harvesting produces an economic benefit equal to the tax saved. However, sometimes it can only provide a timing benefit. This is a tax deferred strategy that could be valuable. Capital losses are highly tax effective if they can be used to offset some income tax at higher rates. A key factor to remember is you can save up to $3,000 in capital loss above capital gains to offset ordinary income. We've been doing that quite a bit this year. Also, as a warning, watch out for the wash sell rule. This is really important. The rule prevents taxpayers from repurchasing a substantially similar security within 30 days of selling at a loss. Especially in the funds, you have to be very careful here. Again, if you have any questions on that, please, we've been talking to a lot of you about it. We'll continue to do that through the end of the year. But if I haven't, please talk to us if it's something that, if your taxes are killing you, there might be a way we can help you. So capital gains harvesting means taking capital gains in the current tax year. On the surface, it might appear that taxpayers should always harvest gains because of favorable rates. However, harvesting gains introduces a trade-off between lower tax rates versus the loss of tax deferral. Remember, when taking a gain for tax purposes, although the tax is paid at a lower rate, it is paid sooner. So in a few minutes, and this is when I've talked about paying attention to capital gains, we're going to talk about some tax policy proposals. But this here is timely, so let's look at one of the former Vice President Joe Biden's tax proposals that is about capital gains rates. The proposal is to eliminate the preferential rate for long-term capital gains and qualified dividends on income over $1 million. This is a significant proposal and a fundamental shift because capital gains rates have never been eliminated for any taxpayer. The proposal for those effective basically increased from 20% to 39.6%. If it looks like this could be enacted, then at today's lower rate, some people could sell assets. I've been talking to you a lot about that. And the only way these things get implemented, remember, and I've been talking to you a lot, it's not about the presidency for us in terms of our dollars. It's about the policies coming out of Congress. So if the Democrats sweep Congress, remember, markets like certainty, not uncertainty. So that's going to mean tax policy change into next year. So we could see some heavy sell-off after the election, with people taking advantage of today's current tax laws. And this, even though these numbers seem high, this could affect a lot of people. That, over the last couple of years, people, even in the low income, having large gains on different things over the years is not unheard of. So this could affect many, many of us. Let's look how this works. Old 2017 rules had 3 rates for long-term capital gains and qualified dividends. 2020 still has 3 rates for long-term capital gains and qualified dividends. 2022 could bring 4 rates for long-term capital gains and qualified dividends. Therefore, we need to continue to follow the tax laws, changes, and proposals. It's going to be very important. You want to always remember you to review year-end retirement contribution planning. This is something now going into next year. A lot of this you have until April 15th of next year, but we've really been encouraging everybody this year. You want to max out these things where you can. A lot of people, especially younger people, if you have Roth IRAs, anybody that's prior to retirement, coming into retirement, younger people, if you're doing your 401k, or maybe it's a simple or SEP, and a Roth IRA contribution as well. It's pre-tax and after-tax dollars. It becomes very important to have all those buckets later on in life. So another critical area to review before you're in, because of the Secure Act that was passed last year, is what we refer to as overall family tax bracket management. Logically speaking, if you're in a higher tax bracket than your beneficiaries, then it might make sense to let them take distributions after your death in their tax bracket rather than you and yours. However, if your beneficiaries are in a higher tax bracket, then it might make sense to take distributions in your tax bracket before death, and then to convert these accounts to Roth IRAs and leave your beneficiaries an account that still must be taken out in 10 years, but it's taken out tax-free and it grows tax-free. You would wait, unless you needed the money, you would probably wait until the 10th year and take it all out. An annual step to consider is to review your marginal tax rate and your beneficiary's marginal tax rate each year. We've been doing that a lot for a lot of you. We're going to continue to do that. In some cases, it makes sense, and some it doesn't. And we have had both situations where it makes sense to let your kids pay the taxes versus you pay the taxes, and vice versa. I like to have everything on one screen as we're talking about. Some benefits from Roth IRA conversions include they could lower your overall taxable income long term. Roth IRAs enjoy tax-free compounding, and they also are not part of that calculation at 72 for the required minimum distributions, RMDs. So it's really important, those of you that get into your mid-60s and you retire, your income becomes lower and we can convert. That's why we're really looking at that and convert as many of those dollars into the Roths. At 72, that doesn't become part of that RMD calculation. And if the tax rates go up next year, in the next few years going forward, depending on what happens here, this is going to become really, really valuable. And of course, the Roth IRAs allow tax-free withdrawals for beneficiaries as well, as we just mentioned. Now let's turn to 529 College Savings Plan, especially in the state of Oregon. A little change here, a little aggravating change, I guess, for us anyway, for you too. Qualified tuition plans, also named 529 plans, are a great way to tax efficiently plan the financial burden of paying tuition for your children or grandchildren. Originally, earnings in the 529 529 plan originally could be withdrawn tax-free only when used for qualified higher education at colleges and universities, vocational schools, or other post-secondary schools. However, the rules changed so that now 529 plans can also be used to pay for tuition at an elementary or secondary public, private, or religious school up to $10,000 per year. Unlike IRAs, there are no annual contribution limits for 529 plans, but instead there are maximum aggregate limits which vary by plan. Under federal law, 529 balances cannot exceed the expected cost of the beneficiary's qualified higher education expenses. 529 plans limit varies state by state, ranging from $235,000 to $529,000. Some states even offer state tax credit or deduction up to a certain amount. This is where Oregon just got affected here this year. It used to be a tax deduction, it's now a credit, which is not, it's not as good as it was as a tax deduction. So a major change here for Oregon. Contributions to a 529 plan are considered completed gifts for federal tax purposes. So in 2020, up to $15,000 per donor per beneficiary qualifies for the annual gift tax exclusion. Excess contributions above $15,000 must be reported on IRS Form 709 and will count against the taxpayer's lifetime estate and gift tax exemption amount. It's currently at 11.58 million in 2020. There's also an option to make a larger tax-free 529 plan contribution if the contribution is treated as if it were spread evenly over a 5-year period. For example, a $75,000 lump sum contribution to a 529 plan can be applied as though it were $15,000 per year, as long as no other gifts are made to the same beneficiary over the next 5 years. Grandparents and sometimes use this 5-year gift tax average as a state planning strategy. Congress still has not closed this loophole, which has been interesting. If you want to explore this or sign up a 529 plan, we can help you. Just give us a call because it can be very confusing. Oops. So on annual gifting now, you may gift up to $15,000 tax-free to each donee in 2020. So if you want to gift to your children, it's $15,000 a piece. These annual exclusion gifts do not reduce your lifetime gift tax exemption. This annual exclusion gift is doubled to $30,000 per donee for gifts made by married couples. You can also help someone with medical or educational expenses without incurring gift taxes. Sorry, back here. There are opportunities to give unlimited tax-free gifts when you pay the provider of the services directly. The medical expenses must meet the definition of deductible medical expenses. Qualified education expenses are tuition, books, fees, and related expenses. So it works a little different than the 529, but it does not, because it does not include the room and the board. You can find the detailed qualification in IRS publication 950 and the instructions for IRS Form 709 at www.irs.gov. So be careful on this between gifting and between 529. Works a little different. So a wealth transfer planning item to think about is the exemption amounts for gifts to state and generation skipping taxes for 2020 is 11.58 million or 23.16 million for married couples. Any amount over that is subject to 40% federal taxes. This high amount provides high net worth individuals a significant planning window to make gifts and set up an irrevocable trust. So that's on the federal side. We also have the state sides, and both Oregon and Washington are a little different. So there's federal side, most people fall under that, but on the state of Oregon, state of Washington, most people don't. A lot of people fall in that estate tax, state tax. As a reminder, as of now, in 2026, though, these estate tax exclusions will return to 5.49 million, which is 5 million adjusted for inflation. On November 26, 2019, the Treasury Department and the Internal Revenue Service issued final regulations under IR 2019-189, confirming that individuals who take advantage of the increased gift tax exclusion portability amounts in effect from 2018 to 2025 will not be adversely impacted under the Tax Cuts and Jobs Act sunsets on January 1st, 2026. This could change next year depending on what happens, so we want to be watching this. We've been looking at estate planning. That's why we're looking at all your estate plans right now, looking at those documents. It could have major implications for your heirs later on. Okay, so if Joe Biden wins, let's look at how some of the changes that he's proposing. And again, this will only come about if the Congress, if the Democrats sweep Congress, because right now it's gridlocked. And so if the Democrats sweep Congress, then you'll see these changes. So even though this is the elections in November, Democratic Party nominee Joe Biden, he's released some of these possible tax law changes that he would like to make if he wins the presidency. While these would be future changes and must be approved by Congress to help you think about planning for your future strategies, here are some of the proposed changes to be aware of. He wants to increase the corporate tax rates from 21% to 28%, increase the marginal tax rate for top earners from 37 to 39.6, raise the capital gains tax on filers' incomes above 1 million to 39.6%. And again, as I talked to you before, is this could affect more people than you think. So we want to be aware of this big time. And I'm not getting into politics here. I want everybody to be aware. It's just a lot of things could change here, and we need to be on top of this to help you. Limit itemized deductions. Under Biden's tax plan, it includes a cap on itemized deductions of 28%. So this means for each dollar of itemized tax deductions, including charitable contributions, a taxpayer or a couple filing jointly would only receive a maximum benefit of 28 cents, even if the filer is paying a higher marginal tax rate. Phase out small business income deduction for those earning over $400,000. He also wants to eliminate the step up in basis. A step up in basis refers to the cost basis of assets or properties transferable to an heir upon death. If, as an example, an individual purchased a home for $300,000, but it was worth $600,000 at the time of their death, today their heir would pay capital gains on anything over $600,000 if the home were ever sold. Under Biden's tax proposal were to become, and if this would become law, the heirs would not inherit a stepped up in basis and have to pay taxes on anything over $300,000. So this is a big deal for all of us. Reduce the state tax exemption to $3.5 million immediately. That means the states over that value would be taxed. So this could have some pretty good implications. Suddenly, where we've been worrying about the state income tax, the state income tax, now we got to worry about the federal estate tax too under these proposals. So in summary, it's a little bit of a checklist here. Here's some items that you should review prior to your tax time. What is your bracket? What is your tax bracket? Do you take standard or itemized deductions for timing purposes? Capital gain and loss harvesting, retirement planning contributions, education planning opportunities, charitable gift planning, and estate tax planning opportunities. It's also helpful to think about tax planning for any major financial or life events next year in the future, as well as tax planning for any other personal situational concerns. A lot of you, this just came out and you all should have received this by now. It's our tax report for year-end tax planning. As we said when we started, we want to look at a proactive approach to your tax planning instead of a reactive approach. I've been talking to many of you about this, but I just want to get this out there because as we go through, and depending on the election results, we may have to really look at this harder at the end of the year versus the beginning of the year. We'll just have to see how all this plays out. If anyone you know could benefit from our report on this with this information, this workshop we put together, pass it along to them. Let them know. You can send this link. This is going to come out to you as a link. You can send this to anybody. We enjoy helping others and always consider an introduction to others to be the highest compliment we could receive from you. We appreciate them very much. This could be, could be a friend, it could be a neighbor, co-worker, somebody that's just going into retirement or has retired, a divorce situation. We're just getting them on our mailing list, and then they get the same information that you're getting. So again, we really appreciate it, and we want to thank you very much in advance for that. We honor it very much. So with that, we'll stay tuned here. We'll see what happens here in the next few weeks. It's been an interesting year. I hope next year is a whole lot different, a more positive way in terms of being out, getting out and do things. New York Times, I think it was the Times this morning, came out and they see this pandemic ending sooner than we originally thought. So let's hope they're right. So with that, have a great day, and we'll be back to you soon.